Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our Primary Vision Frac Spread Count show. So we're going to talk about what's happening in the US, and then we're going to go abroad. And we really want to look at what's happening with ducks, and then looking at some of the policy changes that have happened over the last few days, especially when we look at China, a potential Iranian deal. And then we're going to also talk about just PMI and inflation, because we did a whole report on inflation today. Now, we'll keep it light on econ data. We'll do more next week, because we did have a busy show this past week. So just to jump right in here, the frac spread count was 0. So it was no change week over week. We came in at 223, which is, again, kind of what we've been expecting, where we were going to flatline. But now, as we go forward into the next few weeks, we think that we're going to start getting this slow grind higher. And it's not going to be this huge surge, but by the time we get to about the middle of June, we should be at about 230, 235 spreads. And it's really driven by your typical cast of characters, which is, the Permian and the Western Gulf. So then when we look abroad, especially when we look at the 3-month chart, we just want to look at some of the other benefits that we're going to see, because obviously we're going to get some growth in the Permian, some just in Texas in general. But we're also going to get this slow rally higher in the Bakken as well, because the Bakken is going to need to see an additional just activity. We need more rigs, we need more spreads in order to keep production fairly flat and to keep that going forward. And given the year-over-year chart, we're you see that we were at a bottom. Now we're starting to rally higher. But when we think about rate of change, it's really looking at in terms of what's happening on the perspective of the Bakken and where the Bakken is in general, and just activity overall. Because the Anadarko should see some additional, we have to see some more in the Williston if we're going to keep things flat. But then the smaller basins, are ones that we're going to see this 1 or 2 start coming in just to see some of that growth. And the reason why we talk about that is because, one of the things that we wrote an article for AOGR, we've been talking about this really since the beginning, that, or I should say the beginning of the year, that we were going to get this big increase in spreads that was going to stem the decline curve, the production declines, and then really start to get back to growth. But you're utilizing ducks. You're seeing duck activity that has been whittled down, and this is just the most recent data from the EIA, where you can see that we had a continuation of these drawdowns. Now, we've started to see some increase in rig activity. That is going to, and at this point, it's enough to stem the decline in the Permian. Not that it's going to start to increase, but again, we're starting to slow some of those levels. But the biggest concern right now is the Bakken and the Eagle Ford, where we really need to see some of these activations in order to provide that running room for ducks and for completion crews. So that's just to kind of reiterate what we were thinking, that we were going to get spreads activating quickly, and then as we started to get into the summer, middle of spring into summer, that we were going to see a big increase in rigs in order to provide this replenishing of inventory. Now, before we go on to some of the policy changes, we just wanted to talk quickly about the 5-year average, because we keep hearing about the 5-year average, like, we have to get back to the 5-year. Well, if you think about the OPEC's most recent report, commercial inventory stood at 3.1 billion barrels of crude and product, 92.2 million above the 5-year average. But what 5-year average? Because depending on the 5-year average that you're working with, it's going to look vastly different. So then if you go 2015 to 2019, the 5-year average was 2.9. Then if you go from 2010 to 2014, it was 2.65. So what is the right 5-year average to look for? Because we continue to have a big glut, not only of crude, but also of product when we start looking abroad. So if you consider what the OPEC said we drew down in Q1, which was about 670,000 barrels a day, well, how long would it take to whittle through some of this excess? And depending on the excess that you use, it's going to take a varying amount of time. Now, when you think about 670,000 barrels a day of draws, well, where does Iran fall? So one of the things that we believe is that the Iranian deal won't happen before the election. If you consider what kind of message that would send, and it would be a means of the local government, we could use this as a political tactic of, look at what we were able to achieve. We're able to do this. And realistically, I would say that they wanted the framework in place in order to wait for the outcome, because if it's a positive outcome, unlikely, but if it's a positive outcome, then you already have a framework to go off of and you could speed this up. But when you look at the fact that the populace is already talking about boycotting the election, it's unlikely to see a pivot. Now, that's one side. The other side is India, China have already been buying Iranian crude, not so much India, but obviously China has. So they could sit there and say, look, we can't afford to continue this. We have to start buying. We need the condensate. We need the oil. So that puts the U.S. at a disadvantage when you're thinking about some of the abilities and what this would mean. But what does Iranian crude coming back mean? We know that they've increased exports by about 500,000 barrels, 400 to 500,000 barrels a day. But not only would it put more crude on the water, but it would put more condensate. And the reason why that's so important is because when you look at the shortages in the Asian markets, it's really on the condensate side. You look at naphtha, you look at LPG, and it's because they're struggling to find feedstock for the chemical side, because refiners continue to run at such reduced rates, given the issues that remain on the refining side, demand side. So again, those are some of the problems. But now we take it a step further. So when we look at what China has done, they're now going to put a levy on 3 different types of products, which is the light cycle oil, bitumen, and this other and another form of blending stock, like a fuel oil type. So the 3 different types are levies that would go against essentially semi-finished or semi-refined crude products. And the reason why that's so important is because South Korea, so just to break it down, it's South Korea, Malaysia, and Japan are large exporters into the Chinese market. So if you just look here, you can see just how much, about 1.5 million tons went into China, and you can just see how much of it came from South Korea. Now, the bitumen side, that is more from Venezuela. So even though it's labeled as Malaysia, it's more Venezuelan. But this is going to hit teapots the most because a lot of them were using this fairly cheap product in order to blend it into their current runs. And this was enabled to just increase total volume without having to worry about crude or importing more crude. So what is this going to do? This is going to shift the paradigm in the sense where now China is going to have to import more oil, but it also means that South Korea and Singapore and Japan specifically are going to have to cut runs or at least limit runs because they're not going to be able to export this extra capacity. Now, that's just going to shift the way crude is moving in the system. On an aggregate level, it's net flat. Now, what happens with Malaysia? Are we going to see these Venezuelan barrels back up into Latin America? That's something that's going to remain to be seen. But when you could just consider the sheer size of where this could target, we're seeing a big cut coming off of this light cycle oil imports. And when you consider how is that going to shift, it's really coming after teapots or the Shandong independence. And that's what we keep talking about, is because China is trying to protect the SOE margins as they continue to bring on new capacity. So they need to force others to shut down or at least cut runs. And this is another means of doing so because they've already hit the teapots with with additional sanctions in terms of investigations. So this is just another pressure point. So then when you look at the different grades and what is happening overall, this is when we shift to what is the loading schedule overall. And as we said in May, you can see the deferrals from Nigeria where you've had this movement out of May into June. And the biggest problem right now is even though we have a slower number, and you can see that Angola and Nigeria have already started talking about July, Nigeria's oil for loading next month is selling slowly, which is June, with at least a third of the June cargoes yet to find buyers, which is about 20 cargoes. Now, the problem with that is this is happening when they've already announced July, so they're typically much further along. And another hit to it was India only ended up buying about 3 million barrels, and the expectation was for it to be more than 3 million just because they skipped a month. So the fact that India still didn't come in with any meaningful buying outside of some of their normal is putting additional pressure. Now, take what is happening with Nigeria, and now let's look to Angola. So Angola has 5 to 6 cargoes remaining, and they already have July. So again, that slowed down. The Congo has slowed down. So West Africa continues to struggle, and it comes back to, well, is this going to be impactful to the way things are shifting in China? So then when we look over to pricing, so euros went off at a lower price where CPC was at a bit higher, and just to put that into context, so when we look at euros came across at $2.10 below dated Brent, which was previously $1.95. When we look at CPC, it delivered at $2.20, where it was initially $2.35 below dated Brent. So you're starting to get a little bit of adjustment. ESPO continues to clear at a fairly steady clip. But the overarching problem remains not only just West Africa, but also the Middle East, which we continue to see this glut of crude, sitting offshore. And even though we're starting to see the next round, we're not seeing any type of movement or meaningful movement to absorb this. And then when you take that and look at, well, let's look at Angola. So Angolan crude loading, so they're having trouble clearing, but they're at a near all-time low in terms of exports. So they can't clear, but yet they have very little they have depressed exports. And this is where the issue that we continue to see is arising in terms of the amount of available cargoes. Now, when we look abroad and look at just where do things sit on the refined product side, we had some draws out of Europe, which is a net positive. We had a small draw out of Singapore. Now, the way this is going to work in general is that we're going to see some backfilling, and we've already started it. Now, just to give you an idea, into Europe, for an example, so Middle East cargoes are going to reach a 7-month high, with 28 tankers hauling about 1.86 million tons. That's going to be coming into from the Middle East into Europe over the next month, which again is going to kind of backfill. They are seeing some more activity. We should see about 800 to about a million additional barrels leaving the U.S. into Europe, which again is going to support our view of that 2.6 to 2.8 million barrels a day. And when you consider just, okay, well, let's put the European component into context. So the previous month in April, they were at 1.74, which was the highest this year. So you're getting an idea of just kind of where things are going, where as they slowly come back, they're just going to take advantage of the amount of stranded product that remains not only in the Middle East, but also in Asia, which is when you look at Singapore, how we continue to think that we're going to get some of this backfill just because we remain at an elevated level. And then when we look at just the Shandong independent refiners, you can see that they've essentially flatlined in terms of activity. But our view is that they're going to continue to fall closer to the 5-year average just because they're going to remain under pressure. Obviously, the 5-year average is skewed with 2020. But based on where we are and just where the pressure remains, it's going to be at the teapot level. Now, while all of this is happening, when we look at the Shandong crude stocks, they're back to a 2021 high, back to the highs that we saw in Feb and March. And when we look at offshore with the amount of crude that remains in the system, especially on the offshore side, this is where we continue to see some of the struggle in terms of offshore onto onshore, because they still can't work through a lot of this capacity. and they're cutting runs, or at least not increasing runs because of the pressure points. And then when we look at fuel oil, this is where we expect to see this continue to drift lower as they try to manage some of this activity, especially within the Chinese markets. Now, when we look at PMI, because obviously PMI came out very strong today, and we want to talk about this not only just in terms of economic growth, but inflation, because we continue to see throughout the supply chain, as we tried to lay out in our insights this week, that inflation continues to creep into the system. And when you look at just where we sit on the composite, so 68.1, blew through estimates, very strong. But then when you look at the breakdown, services saw the biggest growth and the biggest activity of 70.1, and then manufacturing at 61.5. So the services is going to continue to see that as we see that reopening. But then when we look at jobs for May, it looks like that things are starting to slow down a bit after seeing, again, that surge in April. Then we had that big miss in May. I'm sorry, we had that big surge in March, then we had that big miss in April. Now we're starting to see some of this pressure in May. But when we look at what is driving some of these numbers, well, prices charged rose to 65.6 versus 62.2 in April, highest reading since series began and 12th consecutive month of expansion. So that's the prices charged. So we continue to see consumers and corporations getting charged more. And then the input prices rose versus the prior month, highest reading since the series began. So input prices and output prices continue to drift higher. So then when we go to some of the context, increasing cost burdens continue to be felt as the rate of input price inflation soared to a new survey record, often linked to further marked worsening of supplier performance. Again, supply chain disruptions continue, thus, just the inability of moving product. And then some of the things that were talked about was PPE, fuel. I don't know if you saw, but FedEx has doubled their surcharge, which again is just more surcharges, more cost getting embedded, because PPE, fuel, metals, and freight costs are amid significant supplier delays. The steep rise in costs fed through to the sharpest increase in output charges since data collection started October 2009, with record rates of inflation registered for both goods and services. So again, we're continuing to see some of this push through. So clearly, at some point, the market's going to reject it, but at what point? And that's where we continue to see some of this bifurcation where jobs are slow, wages are starting to get better, but they're, again, still not keeping pace as inflation is moving to the next level. And then a quote from the market economist: with businesses optimistic about the outlook, backlogs of orders rising sharply, and demand continuing to pick up both at home and in export markets, the scene is set for strong economic growth through the summer. The May survey also brings further concerns in relation to inflation, as the growth surge continued to result in ever higher prices. Average selling prices for goods and services are both rising at unprecedented rates, which will feed through to higher consumer inflation in the coming months. And this is where we keep looking at the supply chain, because it's happening at the beginning point, whether that be China, South Korea, Japan, Germany, in terms of exports into the U.S. And then when we look at import prices, and that pass-through is just feeding down the system. And here's just another data point showing that we're going to continue to see that inflation moving through. Now, before we let you go to enjoy your weekend, we just wanted to give a quick update on Israel-Gaza. As of 2 a.m. this morning, they do now have a ceasefire. It was brokered by Egypt. So far, things look to be holding. Israel has been working with the Gaza and Egypt to figure out the best way for rebuilding, just because they now have a responsibility to come in and start to rebuild some of the assets, especially some of the buildings that were brought down. But what does that need? That you need cement, rebar. But you also don't want those to fall into the wrong hands to go to make more tunnels. So there's going to be that negotiation as to who's in charge of that, who's going to be responsible, and is there going to be some mediation where maybe a group or a council is set up to look over that, whether that be Jordan, Egypt, members from Egypt, Jordan, Israel, and Palestine, to make sure that things are moving along, or some other third party to make sure that things are going, or assets and goods are going to where they're supposed to be. So, there's a lot to talk about, a lot of things that are moving in terms of the inflation, activity in the market. But when we look out in terms of pricing, that's where we continue to see some of these pitfalls as to consumer prices. But we'll cover that more again in our EIA show and our economy show next week. And we hope you have a great weekend. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.